In today's video, we're going over frequently asked questions that we hear all the time from federal employees. So stick around. Hey, my name is Mel Stubbs. I'm a financial planner at Christy Capital Management, where we're helping federal employees plan for a better retirement. If you need help, go to christycapital.com and click Talk to an Advisor. Today, we're going over some frequently asked questions for FERS employees and retirees. So the first one, when is the best day to retire? So once you're eligible, for some people, the best day is any day. As soon as you get upset enough that you don't want to work anymore, that's the best day. But typically speaking, the best day is at the end of a month. So at the end of the month, that gives you the shortest gap between your last paycheck and your first retirement check. And so, it doesn't have to be like the last day of the month, but near the end of the month, the closer to the end of the month gives you the shortest gap. Now, to take it a step further, what about the end of the month? That's also the end of a pay period. If you retire mid-pay period, you don't accrue your leave for that pay period. Also, maybe not the biggest deal in the world, but if you're trying to get super efficient, end of a pay period, that is near the end of the month. Another thing is, what about the end of the year? What about the unused annual leave game? You're only able to carry forward a certain amount of unused annual leave. So in theory, you could, the next year, like your last year of working, just stockpile as much annual leave as you can and then retire at the end of December. So it could be the end of the month, end of the pay period, and then end of the annual leave kind of calendar where you can get the biggest cash value check you can because your unused annual leave is got a cash value. They're going to pay you a check for that. So that could be it. Other things we hear, some people want to, retire before summer to be on a summer vacation, maybe retire before Thanksgiving and the holidays. So that type of thing would be a personal preference, but end of the month, end of the pay period, end of the year are typically what we talk about. So the next question, how is my annuity computed? So it starts with your high 3 times your number of years of service times the correct percentage. So your high 3 is your 3-year average, 36 months, where you had, the highest earnings during that 36-month period. Now they take the 3-year average, they divide it by 3 to come up with your average salary. But whenever the highest was anytime in your career, multiplied by your number of years of service. Now, so you got your start date, you've got the date you retire. All of that time is your service history. Now, if you've bought back time, if you bought back military time, there's some different things that kind of go into that number, but you need your service history. And then you use the correct percentage. If you're retiring under just normal FERS retirement, you get 1% per year. So high 3 times your number of years of service, let's say 30 years, times 1%. If you retire and get the enhanced annuity, that's where you're over 62 and you are got at least 20 years of service, the percentage would be 1.1%. So high 3 times your number of years of service times 1.1%. So next up is special provisions computation. So if you're a special provisions employee, you would know it. This is air traffic control, FBI, there's different ones that qualify. The computation is broken down into 2. You've got your high 3, same as before, times your first 20 years of special provision service times 1.7%. So not 1%, but 1.7. First 20 years, you get 1.7%. Then all the remaining years after that, you get 1%. So you got high 3 times your number of years of service times 1.7, you get a number. Then you come back and do your high 3 times the remaining years above 20 times 1%. You'll get a number. You add those 2 numbers together to get your computation. What it tells me is that you get the higher percentage for the first 20 years. After 20 years, you're just accumulating at the 1%. So the next one, how's my high 3 determined? Kind of talked about that already. Your 3 consecutive years of highest pay, to divide it by 3 to get like your highest annual salary. That can be any time in your career. So it doesn't have to be at the end, though a lot of times it is at the end. Next up, what happens to my sick leave when I retire? So your sick leave, there's a conversion chart. You can look up on the internet, OPM sick leave conversion chart. Your sick leave adds onto your time. So if you've got 30 years of service and you've got a year of sick leave, you have 31 years of service. So when we do the computation, it'll be your high 3 times 31 years times your percentage. So your pension is going to be a little bit higher every month because of your sick leave. Now, next up, what happens to my annual leave when I retire? Annual leave has a cash value. So remember, sick leave adds onto your time. You get a little bit bigger pension every time because of sick leave. Annual leave, they take your ending salary, whatever your hourly rate is, and multiply it by the number of annual leave hours that you have, and you get a check after retirement. When am I eligible to retire? So here's a chart right here that shows you the different ages. You've got your MRA plus 30. MRA is minimum retirement age. If you've attained that and have 30 years of service, you can retire. If you're 60 years old with 20 years of service, you can retire. If you are 62 with at least 5 years of service, you can retire. These are the normal FERS retirement eligibility. If your special provisions, yours would be different. What is the SRS? So this is the Special Retirement Supplement. Now, lots of people refer to it as like the Social Security supplement, but it really has nothing to do with Social Security, like the entity Social Security. Now, when you do the math, it does have something to do with Social Security. So if you retire prior to age 62 and you're a FERS employee, you are eligible for the Special Retirement Supplement. So to figure out what it is, they take your Social Security amount that you would get paid at age 62. So like the early, if you take Social Security early, what is that discounted rate? What is that amount? They multiply it by your number of years of service divided by 40. So for a lot of people, they got 30 years of service. 30 divided by 40 is 75%. You'd get 75% of that Social Security amount. It goes up until 62 and then it stops. If you choose to turn on Social Security at 62, for lots of people, they're getting a raise. You know, in our example here, you were getting 75% of it. Well, at 62, you get 100% of it. So that's the Special Retirement Supplement. Next up, when can you leave the TSP? So if you're working and you're 59 and a half and over, you can take your money and move it out of the TSP. And we've got lots of videos talking about the different things that you can do in an IRA that you can't do in the TSP, like Roth conversions, like getting help, like different investment choices. That might be a reason why you want to. So if that's you, if you're still working, 59 and a half and over, you can move your money out of the TSP and keep working, keep getting a match, all that good stuff. If you retire, no matter what age you retire, you can move your TSP out of the TSP. All right, and last up, health insurance after retirement. How does that work? So as long as you've been on the health insurance, the federal health care for the last 5 years at least, going into retirement, you can take it with you. Now the premiums stay the same. There's no penalty because you've retired. The difference is while working, you were paying it before taxes. Like it's kind of a tax deduction to pay your health insurance. Once you retire, that doesn't happen anymore. You got to pay with it after tax dollars. But you can keep the same plan. There's the annual, where you can kind of change your plan every year. Everything else remains the same. The only difference is you got to pay for after tax dollars. Do keep in mind on the survivor benefit, if you want your spouse to keep the health care, you got to pick a survivor benefit. There's a tie-in there with health insurance and the survivor benefit. But that's some frequently asked questions that we get. If you need help, go to christycapital.com and click Talk to an Advisor. If you want more information on Roth, check out this video right here. Go to christycapital.com/webinar, sign up for one of our webinars. If there's anything we can do for you, please let us know. My name is Mel Stubbs. Talk to you on the next video.